Hey everyone, I'm Matt here with Down to Trade. Once again, I'm joined by the strategy guru, Varian Croft. Varian, how's it going, buddy?
Doing awesome, man. Happy to be here.
Awesome, dude. So today we're going to be diving into an advanced option strategy that's really intriguing, not only by its performance, but also by its name, the Iron Butterfly. I know we typically try to keep these videos relatively short, and so we usually don't get the chance to take really deep dives into our topics, but we're going to mix it up a little bit today, and we're going to be try to unpack as much as we can about iron butterflies. And I really don't care if you've been trading iron flies for years or if you've never heard of them. You're going to get something out of this video. Plus, as always, at the end, Varian's going to be introducing us to a strategy creation that's actually wrapped around iron butterflies. So looking forward to that.
Yeah, absolutely. There's really a lot to unpack, but our deep dive will open up your eyes to everything you've missed about this fantastic strategy.
I couldn't agree more. So let's just jump right in. Look, an iron butterfly is essentially a play on a stock or an index where we think price is going to stay within a specific price range, right? But what makes it different from, let's say, a simple call or a simple put option?
Well, so opening a short iron butterfly combines 4 options contracts to create a position with a defined risk and reward. It's centered on a stock's current price. It's about selling an at-the-money call and put, which forms the body, and then buying an out-of-the-money call and put to form the wings. The structure limits your risk to the difference between the strikes minus the net premium received.
Exactly. Now that sounds like a mouthful. So tell you what, let's actually jump over to an options chain and see if we can get a visual that way. Taking a look at the options chain, I think we're going to get a much better idea of what exactly all of that really entails. So let's start off with something most of us are familiar with. Now, we all pretty much know that a put credit spread uses a short put and a long put. So for instance, we could set up a put credit spread that looks something like this, ensuring that the short leg is closer to the money than the long leg. And because that short leg is closer to the money, we receive a credit for that short leg that is more than the debit that we paid for the long leg. And therefore, it results in a net credit, hence the name credit spread. And we all know that because it's a put credit spread, this is a bullish position. It's the same thing for the call credit spread. If we were to grab, let's say, a call credit spread that looked like this, again, we receive a net credit for this bearish position as well. And we're aware that when you enter both the put credit spread and the call credit spread, it's called an iron condor. Now, taking a look at our analysis tab for that trade, if we look at our analysis curve, we see that we have a rather large profit tent. And as long as price expires anywhere within this tent, we get to keep the entire net credit. Now, if we move our strikes closer, or if we move our short legs closer together, we see that the tent actually gets smaller and smaller. But what happens if we move our short legs to the same strike? Well, let's go back over to the table and see what I mean. Again, if we can move our tent smaller and smaller, and we're still in an iron condor. But what happens if we end up moving our short legs, our short put, and our short call to the exact same strike? If you think about it, remember, with an iron condor, price has to expire in between these two strikes in order for us to collect or keep our entire net credit. But if we open the condor with the same strike, there is no space between the legs, with the short legs, and so price would actually have to expire exactly on our strike for us to keep the entire net credit. All right, so now you're probably thinking, well, what happens if price doesn't expire exactly on your short strike? Well, your profit tent actually extends from the center strike by the amount of your net credit you received. Let's dive a little bit further, and I'll tell you what I mean by that. There are 2 ways to really think about this scenario when looking at this on an options chain. First, as we've already discussed, we can kind of think of them as a special iron condor. Remember, so this is your iron condor. Again, we could think of an iron butterfly as an iron condor whose short legs just happen to be at the same strike. Okay, typically at the money. So if money is now here, if this is your at the money strike, typically you'd set up your iron butterfly to look like this. Or we could think of it as a combination of a short straddle and a long strangle. For those of you who are not familiar, a short straddle is when you sell a put and sell a call at the same strike. That's a short straddle. A long strangle is when you buy an out of the money call and buy an out of the money put. So these two long legs would be your strangle, your long strangle, and these two short legs would be your short straddle. Think of, I always remember the difference between straddle and strangle. Straddle, like you're straddling a fence. This is one fence, and you're just straddling a fence, so it's along the same fence. A strangle is on the outside. Okay, now both of these views are actually correct, meaning an iron butterfly is an iron condor with the short legs at the same strike, but it's also a combination of the straddle and the strangle. And you can think of an iron butterfly in either way that makes more sense to you. But now that we know what an iron butterfly is, let's look at the chart to get a better idea. So we're looking at March 27, 2024. Now just imagine at 10:01, I entered an iron butterfly by selling the 52.25 straddle. So in other words, I sold the 52.25 put, but I also sold the 52.25 call. That's our straddle at the 52.25. But then I also bought a strangle, these out of the money strangles. In this case, it was the 52.55 call. I bought the 52.55 call and I bought the 51.95 put. So here's our entire iron condor, or I'm sorry, iron butterfly. Now, remember, with this strategy, I do not want price to move a whole lot. In fact, I would love if price just kind of hung out sideways all day long, because remember, if it expires exactly at my strike, I get to keep the entire net credit. So what we can actually do is draw an example profit zone using the ARC tool. And that's what I did here. Using this ARC tool in TradingView, I drew an example profit zone. In other words, theoretically, this is where your break-even points would be throughout the day. Now, in reality, I'm not able to actually change the shape of this ARC tool in TradingView, but in reality, the real shape would look something like this. It would actually be typically a lot wider than this, and it would actually look something more akin to this in reality. But again, I can't really change the shape of this tool, but it gives us something to work with. But one quick thing to note is there are only 3 places on this arc that are exactly correct. Again, the shape of the arc might not be correct, but there are 3 places that are exactly correct. And that's your entry point at your strike and your 2 end zones, your 2 end points that are exactly 15 points, or your net credit 15 points away from our strike. So these 3 points would be the only points that would be correct. All of these other points in between for this parabola change throughout the day. For instance, if IV happens to increase, the parabola or your safety cone will actually get smaller. If it decreases, if IV gets smaller, the shape of your safety cone actually gets bigger. But remember, these 3 points never change. Your entry and your expiration points never change. Just the shape of, or how narrow or how wide this safety cone or these break-even points, they vary based on implied volatility and price.
That was a great explanation. So now we know the straddle is centered at the money, but how do you choose your wings or the strangle side of it?
You know, that's actually a really good question. It's really up to you. Now, some traders set their wings really close. Some set theirs far away in order to decrease the amount that they pay for them. And there are pros and cons to both. And that said, I personally set my wings out really far in order to pay the least amount possible for them. And my goal is to make a profit on the straddle alone. Now, keep in mind, if we were to sell the straddle alone, if we were to just open the straddle alone, forgetting the wings, if we open this position just by opening up the straddle alone, the buying power effect would be almost $100,000 per contract. But by adding that long strangle, by adding these two wings, we can actually drastically reduce that buying power effect by like 90, 95% or even more. Now, there is a trade-off here. The closer I get my strangle, in other words, the closer my wings are to my straddle, the lower my buying power effect, but the more I'm going to pay for that strangle. And conversely, the further away my strangle is from my straddle, the less I'll pay for them, but the more the buying power effect will be. So the way I trade my iron fly is by selling obviously the at the money straddle and buying a really far out of the money strangle so I can reduce my buying power effect by like 90% while paying the least amount possible for the strangle. But that's just the way we teach it at Down to Trade. Our goal is to buy to close the straddle for a profit. I don't even care about the strangle. We let our strangles expire worthless. And I really don't care if it expires worthless because I paid almost nothing for it. So I don't mind losing $10 at the end of the day on the strangle when I'm making $500 to $700 on the straddle. But that's just, again, how we handle the trade-off. There will be other traders who approach that completely different than we do. But obviously we don't have time to go over all of our parameters here in this video. And look, if you're interested in learning more how we personally trade the Iron Butterfly, of course, you can always visit us at downtotrade.com.
Yeah. So, I mean, we know every strategy out there has its risks. How do traders manage the risk with iron butterflies?
Well, as with any strategy, risk management is really about position sizing and market timing. But that said, iron butterflies are best suited for stable markets with low volatility, right? We don't want much movement. A sudden spike in volatility can really turn potential profits into losers really quickly. Understanding the market conditions is crucial before entering such trades. That said, there are a number of ways you can hedge this position. Obviously, there's the tried and true method of throwing a debit spread on the side that is being tested, right? If our calls are being tested, then of course we can throw on a call debit spread in order to mitigate that loss, or even keep it close to break even. But here's another very interesting play you might consider. Remember, one of the ways we look at the iron butterfly is as an iron condor, right? It's an iron condor where the short legs are at the same strike. So if one side is tested, let's assume price is moving up. Let's just assume that price begins to move up and it begins to test our call side of our straddle. Then what would happen is premium would also begin to increase, which obviously as sellers of credit, that's bad for us. Well, what we can actually do is roll our short call higher. Imagine if we bought to close our short call here, and then we sold to open a short call here. This would land us in a real iron condor. Remember, we were technically an iron butterfly is an iron condor. If we just rolled our short call higher than price, then technically we're back inside an iron condor. Think about it. Here's our call credit spread with our short leg and our long leg. And down here, all we have left is a short put and our long put with price in between. That's an iron condor. Now, we will have to pay a debit for that roll, which is fine because remember, we're starting off with a huge net credit on these positions. In this case, in our example, we're talking $15. Now, personally, I look to spend no more than half of my net credit on that roll. By rolling my call up higher, I don't want to spend any more than $7.50 or half of my net credit that I received on that roll. Obviously, by paying a debit, we have reduced our profit potential, but we've also reduced our risk and we've increased our probability of profit. So there's that trade-off. There's that nice trade-off. Yes, we're paying a debit for that roll, but we're reducing our risk and we're increasing our probability of profit. Now, out Down to Trade, we actually have several parameters that we look at for this type of adjustment, including how we adjust our take profits and our stops. But that's going to be an entirely new video. We don't have time to get into all of that.
Yeah, that's for sure. So, okay. Well, I think we really covered everything on the iron butterfly. Obviously, if we missed anything or you have any questions, leave us comments down below. We love to answer questions.
I completely agree. Tell you what, actually, before we're done, let me do one quick thing. What I want to do is I want to talk about that role from a perspective of the options chain. Okay. If you don't mind, real quick, let me just knock this out. Imagine this morning we entered this position right here. Okay. We entered the 52.45 straddle, and we bought the 52.05 call. I'm sorry, the 52.05 put and the 52.90 call. Okay. So this is our iron butterfly position. Now, in this example, price has gone against our call side, right? So I just kind of want to show what that role might look like. And in that case, what we're doing is we're closing this one call leg. So we're buying to close this one call leg, and we're opening it again, maybe down here. And that's our iron condor. Now, it's not a perfectly even iron condor, but it's an iron condor nonetheless. It obviously is heavily weighted on the call side much more than it is on the put side, but you get the idea. Now, us personally, how we trade is a little bit different, because when we open up our leg or our strangles, we go way out of the money. I'm kind of exaggerating here, but that's kind of the idea. So if I do have to roll this, it's not as heavily weighted in one direction or the other. You know, obviously we're still in a very, very, very wide iron condor. I'm sorry, on this side, we're still in a very, very wide call credit spread, and obviously an enormously wide put credit spread. But that's typically how we enter it. Again, we have our reasons for it, and we have our parameters for exactly how we manage that, and how we take profit, and how we manage our trade and our risk. So, but that's typically how we do it. But I just wanted to kind of show you what that would actually look like if we had entered this trade and it started testing our call side. What we're going to do with it is we're just going to roll. We're going to roll it. We're going to roll our short call out of the money so that we can be in an iron condor. And again, that's really, really, really going to increase our probability of profit. We just increase our probability of profit big time. And yeah, again, we had to pay a debit for it, but that debit is absolutely worth it when you consider how we've really decreased our risk and increased our probability of profit. So anyways, sorry about that. I just wanted to kind of jump on that real quick, that example. But I agree. I don't think we could go any further into it in this video. I think we've spent enough time on the iron butterfly for this video. But that said, I guess now would be a good time for us to actually talk about your latest lab creation, which has everything to do with what we're talking about today.
Yeah, absolutely. Yeah, so let's go ahead and take a look. And, you know, since we're talking about this strategy, one of the questions that I'm sure a lot of people have is, how effective is it? So,
Right.
you know, what I did here is I threw it into Options Omega at its rare, you know, its bare minimal rawest form. So this doesn't involve trade management. This does not involve, hey, is this a day that is actually a good day for this type of strategy? This is if it was blindly done every day, and that's it, based on the results. No profit targets. It's literally writing it out until the end of day, putting it in there every day. So, you know, in no way is this what you should do with this strategy, just like we do at Down to Trade. Each day we analyze the markets, we see what the day is like, what our expectations are. We use numerous metrics to determine whether or not we feel it's an appropriate day to take this trade. We also use profit targets and stop losses, which this is not representing. But this gives an idea as how effective it is when it's just blindly done.
Mm-hmm.
So
Now, Varian, if I may ask, I kind of notice up here, you only have the straddle represented here.
Yes, absolutely. So just like what you talked about in the strategy of how we do it at Down to Trade, when we get into the strangle side of things, we are going so far out that we're paying generally a nickel on each side. So we're not even paying attention to that because we're not trying to make money on that side. We're not using that for anything other than reducing margin requirements for the trade.
Yep.
So since the only thing we really want to focus our profitability on is the straddle, that's what I ran this back test on, is the straddle alone.
Right. I love it.
So as you can see here, just like what we talked about, we are selling the 50 delta put and the 50 delta call at a 0 DTE. We are entering this trade at 10:01 a.m. daily, and we are doing it with one contract. And again, normally when you guys watch the back trade sessions that we do, we always have some type of profit target in there. And at Down to Trade, we have those. We have profit targets. We have stop losses that we put in there. This doesn't represent any of that because there's so many ways that it can be handled. And as Amit said, we can go into an hour-long video on how to manage these trades, how to hit profit targets, how to put your stop losses. I mean, we can go on.
Yeah.
So this here is the base concept of doing the straddle alone and letting it run to end of day.
Yep.
And what you can see is it has a 62% win rate. Now, I got to say 62% for what we normally do at Down to Trade is on the low end.
Yep.
We always put our focus up into those high 70s, 80+% strategies, which is, I think, what we really have with the strategy when we're using profit targets and stop losses appropriately. But just blindly throwing this on, it has a 62% win rate. So with no management, 62% win rate with an average winner at $1,100 and the average loser at $1,200, which is putting this at a almost a 1-to-1 risk to reward.
Yep. Which is why you're getting a huge average per trade win here.
Exactly. Exactly. So as you can see, without using any form of technical analysis on the markets, this is pretty much a winning strategy as it is. And in no way should anybody just blindly be throwing this trade on and hoping for the best.
Right.
You gotta trade with stop losses. You want to trade with profit targets. You know, you got to stay in the game. And the only way to do that is to manage risk. Right. This does not have the risk management side of it. So do not just throw this trade on expecting wins out of it.
No, but I love that you showed it this way because this is, in my mind, I would call this worst case scenario.
Yeah, exactly.
Putting on this trade, right? So it's only going to get better with this, with proper management, not only managing the trade, but also proper management of your risk across the board, which we talk about on a daily basis. But man, this is actually really interesting. So even if I were to just mess it up, I'm still looking good.
Exactly. Yep. And that's the thing is when the strategy in itself has this type of potential to it, once you start adding in technical analysis and proper risk management, I mean, you're just in a total win-win situation. All we're going to do is we're going to get this win percentage higher, and generally the average loser is lower.
Right. And obviously we're using different models in order to predict whether or not we believe the market is going to trend in either direction, or whether or not we believe that the market is going to chop sideways. Now, obviously on days where we find ourselves in a more of a positive gamma environment, and we believe the market is going to trend sideways, and we've seen that a lot lately. A strategy like this is going to just blow up. It's just going to look fantastic. Your P&L is going to look great on a daily basis. All right, great, man. Dude, once again, great job, man. Again, a simple back test, but I love that you did it this way. I love that we didn't get into all of the nuts and bolts of all the different ways that we can do with it. You just showed the worst case scenario, and it gives all of us a starting point to begin with. And that's what I love about this particular back test. Look, we're always excited to see what you've got, cooking up in your lab over there, man. So
absolutely.
Look, as always, if you'd like to learn more, if you'd like to see how we use these and other strategies every day in our day and swing trade rooms, I invite you to check out our membership for free. Just go to downtotrade.com. And right now we have some really great promotions we're running, so you don't want to miss out on those. So again, go to downtotrade.com. That's down the number 2 trade.com. And if you like this content, or if you learned even one thing today about iron butterflies, do us a big favor and subscribe to our channel. And don't forget to smash that like button. We'd love to hear all of your questions and thoughts. So please take a moment to leave us a comment. Other than that, really, thanks for tuning in, everyone. That's going to be it for me. Varian, do you have anything else?
No, man, just come trade with us. See what we
There
do
it
on a
is.
daily basis.
Yeah. All right, everybody. Until next time, this is Met and Varian reminding you to learn it, trade it, and profit. Take care, everybody. Happy trading.